Everybody, you ever just have one of those mornings where it just doesn't go right at all? Anyway, uh, welcome back to the show. Welcome to the show. If you're brand new, make sure you subscribe so you can chat with us and grab your caffeine of choice because while you're sleeping, oil ripping back higher. And this is not just a headline, this is starting to be a potential squeeze. We had tons of shorts jumping in. Things didn't settle down as fast as people hoped. And welcome to the Morning Monster, where I drink some Monster Energy drink because coffee is for people who I guess like that sort of thing. Maybe chasing that 2% dividend. You think it's exciting. I'm your host. I love this stuff. I don't like hot liquids. So today we're going to talk about what happens when the geopolitical chessboard gets flipped over and we set the global energy market on fire. So this matters to our wallets, right? Why? Because we're entering what I call a supply shock trap. When supply can't meet demand, price finds the only level that clears the market. And right now, the market is screaming and you're not paying attention to energy right now. Well, if you aren't, well, you might get run over by a macro environment event here. We're talking about inflation rearing its ugly head. See, the Fed rate cut might have to be unwound. The broader market bleeding while energy names rip. Well, this is all like a problem. So I'll look at specific potential setups here in a minute, including XLE, USO. But first, let's look at some of the data. What's going on here? I mean, you hear the headlines, you hear the war rhetoric, but there's bigger fish cooking here. So while we were all dreaming about a soft landing, Brent crude settled above $100 a barrel yesterday, and that's a fresh 2026 high. Iran's new supreme leader, yeah, good luck on me ever saying that name properly. New supreme leader, old dude with a big beard, just stepped to the mic, and his first order of business, well, he called for the Strait of Hormuz to be and remain closed. He wants attacks on U.S. bases to continue and ramp up and amplify, and he's probably not just talking. Fuel tankers were bombed in the Gulf, in the Strait, or whatever, and this is where things get a little crazy. I was talking about food prices going higher yesterday, and fertilizer, based on fertilizer, there are 20 liquefied natural gas tankers. This is half of the global fleet. 20 liquefied natural gas tankers. They look like ships with big bubbles on them. They're stuck in the Persian Gulf right now. Daily freight rates for those ships went from $98,000 a day to over $200,000 a day. 20% of global liquefied natural gas exports come from those Gulf countries, but 50% of the ships are currently trapped there. This isn't just a minor disruption. This is a massive bottleneck. Now, what are we, the United States, the police of the world, doing about it? Well, we announced a release of 172 million barrels from the Strategic Petroleum Reserve. Sounds great, right? Except the delivery of that takes 120 days. That's 4 months. That's not a short-term fix for a market. That market can continue to panic today. The Trump administration is reportedly looking at suspending the Jones Act. It's a restriction on shipping to try to curb these prices, maybe put some down pressure on the prices. And the Navy escorts through the strait might not happen until we get Iran under control more. Got to take out more military assets, reduce their capacity to attack. So, how is this market reacting exactly? Kind of exactly how you would expect, really. U.S. equities getting kind of pressured, and we're seeing some risk-off trading. But longer-term wars are bullish for the market. So this is probably just some sell-off jockeying, and we kind of needed this, really. The Nasdaq's been chopping sideways in a correction since October. So this is not really, this is just the excuse to finish the correction up, not really what's causing a giant sell-off. I mean, we haven't really been making higher highs in Nasdaq since October. We haven't, period. The S&P did make a higher high in February, but we've got down pressure there too. We need to correct it back out. It has nothing to do with war. So we are seeing the S&P flirting with breaking below the 200-day moving average. The near-term key support level, 6,700, but 6,600 is line in the sand. And, yesterday I made cases for it coming on down, possibly even into the 50s, 5,000s, the 5,300s. And almost every sector has been lower except for energy. Haven sectors like utilities, consumer staples, they're catching a small bid. The US dollar printing fresh highs for the year. That dollar squeeze thing might kick off. That weak dollar narrative might go in the garbage can, at least for now. Treasury yields rising for the third consecutive day. And you know what? You know what the Fed does, right? They chase Treasury yields, not the Fed doesn't set the rate. The Treasury yields, the Treasury market sets the rates. The Fed just chases that around. If you're not aware, the probability of a Fed rate cut unwound. Right now it dropped 33%. We were 100% just a couple weeks ago. Now we're sitting at like 60-ish% for a rate cut. And if you look at the DGS2, the Delta Golf CR2, the 2-year constant maturity rate, it's about to cross over the Fed funds rate. They can't cut. They have no room to cut. So we're in a potential inflationary environment. The tools to fight inflation are higher rates. If this thing gets out of control, playing with fire right here. But let's look at the framework. I call this the supply shock trap. Now, the trap happens when, number one, supply gets constrained, like we're seeing with the Strait of Hormuz being closed. Number two, demand stays even or possibly rises. And then number three, we got price finding a clearing level. And number four, that level is going to be higher than anybody wants or kind of thinks about. Goldman Sachs just updated their forecast, and this is the data point that matters. Last week, they said the Hormuz flows would restart after 5 days. Now, this week, guess what? 21 days of closure is their forecast. Now, this is not just a tweak in a spreadsheet. That is the regime change. That's 4 times longer, which means 4 times the supply impact, which means the market needs to be pricing in a 21-day closure. But that strategic petroleum release doesn't happen for 120 days. This is a gap. Gaps get filled by price spikes. We've seen this movie before. Every single time, the pattern is the same. Supply shock leads to a price spike, which leads to inflation, which leads to a Fed response, which leads to market pain. This thing plays out over and over. Now, interestingly enough, we're coming off the cheapest gold to oil ratio we've had. The number of barrels to buy an ounce of gold, take dollars out of the equation. The number of barrels to buy an ounce of gold was at a recent spike. And the historic average is right around 20 barrels of oil for 1 ounce of gold. we've still got a long way to go to bring that back into balance. So in dollar terms, that generally would mean gold lower, oil higher to bring that back into the balance. And we can look at the 1973 Arab oil embargo. We saw prices quadrupling, inflation spiking, the market dropping 45% over 2 years. In 1979, the Iranian Revolution, oil production halted, prices doubled. We got the Volcker shock and a brutal bear market. In 1990, Iraq invaded Kuwait. Some of you might have participated in that. Oil spiked, recession fears hit, the market took a sharp decline. And we all remember 2022 when Russia invaded Ukraine, energy prices took a shock. We saw some inflation ramping up, a massive Fed hike cycle, and a 20% bear market. If you believe they're all interrelated. Now, we're watching it play out in real time. Energy ripping again. Everything else is bleeding out. It started with sector rotation, with AI fears, and it's starting to spill a little bit bigger and broader in other places. And when fear hits, the supply shock trap snaps shut. So how could you play it? In the pre-market, the top gainers lately have mostly been energy names and defense stocks. The decliners, multinationals, Asia, European Union exposure, and rate-sensitive growth names like tech giants have been just kind of churning a little bit. They've all been feeling pressure of these unwinding Fed cut bets. Now, I'm not going to give you trade recommendations here. This is kind of educational, informational, and fun. But if you're watching market roadmap bounces on energy names, well, we're seeing the supply shock trap play out in real time. We're seeing XLE bouncing. We're seeing USO bouncing. We're seeing daily time frames bouncing all around. We're seeing small time frame permutations like these pullbacks and the continuations. You can take advantage of that stuff. We're seeing opportunities show up in Lockheed Martin, Raytheon, Northrop Grumman, General Dynamics. Ties back to the restock cycle 2.0 framework from earlier. Now, if you look at Bullflow Gamma heat map for SPY and QQQ, that's where I wrap up the show with. We kind of see where we're going, where we're pinning, where we're going by the end of the show. And when we break out of these lines, things can get out of control. So it's something to pay attention to. Now, do you have to watch it? No, you don't have to watch it. I do wrap up the show each day with kind of a speculation where I think it's going to go. There's always risk. I mean, if the Hormuz reopens, like if everything gets to be fine and dandy over there, if Iran buys $500 billion worth of spy calls, then calls up Trump and says, all right, we agree to everything, let's settle it. And then the market goes ripping and they make like trillions of dollars. I mean, that's always a possibility. But megalomaniacs tend to be megalomaniacs, and they don't necessarily want to concede to each other. So it could de-escalate. We could see this thesis break, but if Goldman revises their forecast tomorrow from 21 days to 45 days, you're going to have to adapt. And this certainly isn't clear-cut or easy to predict. But right now, the data says that the supply is constrained, demand is steady, and price is going to go higher to destroy the demand. That's just what's going to happen at this point. If you're following this oil squeeze and you want the playbook, well, keep coming back. Make sure you're subscribed. Make sure you keep coming back. We'll talk about some of these actionable setups. We'll look at some charts here in a minute. And make sure you're, if you want even more data analysis. Be part of the community. And we keep coming back. In a world of chaos, the only thing you really count on is relentless, beautiful, terrifying logic of the market, and it's usually irrational. So let's dive into some of the charts now. What do you say? What do you say? Let's jump in some charts, look at where we could potentially make some money today. All trading involves a substantial risk of loss. Past performance is not necessarily indicative of future results. I make predictions. Sometimes they come true. This whole thing's a mess, and I may have gotten some of my details off just a little bit. I don't have a crystal ball. I have a bag of unicorn dust. I have a couple AI agents that help me dig through and find information. I try to keep it straight for you. Sometimes I get a little off kilter as I'm speaking about it. It's not necessarily the AI writing it. Sometimes my mind jumps around as I'm speaking. So this presentation is intended to be informational, educational, fun, entertaining, not a recommendation to be buying or selling any financial instrument. If you desire personal financial advice, hire and consult a financial advisor. I do have bullet points and stuff like that. I'm talking points that I'm trying to hit, and things are getting a little wild right now. But it's all in. I mean, the craziest part to me is that kind of predicted a lot of this months and months ago. We're opening a little bit bullish here today as far as where we closed yesterday, but not bullish at all when you zoom out and look at this. We're pushing lower, and we're probably going to need a spike even lower. And we saw futures dip off. 4:30 this morning made the low, but it wasn't the lowest low. It was a higher low. Coming back up. Downtrend off highs. I mean, this is a downtrend. We haven't broke out. We haven't, we've got this downtrend of highs. We've got this bigger down, like we're accelerating downtrend of highs. This is a concerning pattern right here. We've got this longer term downtrend of highs. We accelerated a downtrend of highs. Now we're accelerating another leg of downtrend of highs. This could very well be the target. Could very well be the target. Now, I posted a chart yesterday in Discord, and I know at least one person asked me, would I review it this morning? And I've been reviewing it. Like, the whole point of why the market usually bottoms on the 12th has to do with these events right here. These events right here. Historically, we're seeing, funny enough, I gave this to a couple people. Funny enough, the SPY yesterday closed at 666, right in front of Friday the 13th. Kind of funny. If you're, I don't know how to say it. If you're superstitious, I guess you might say, maybe that affects your view on the market, but I don't think it necessarily matters. We traders do tend to be more superstitious. So I posted this chart right here. I posted it for everybody. This is take the yearly path of the S&P 500 for the last 20 years, lay it over each other, and find the average day-to-day move. Historically, for the last 20 years, we typically make the low. We actually tend to go negative on average in March. And March 12th tends to be kind of the bottom. Now, the reason all this plays out has to do with this OPEX set right here. VIX, like, it never expires the same exact day. It's always the dates. This is what people get confused by. If you could put if you could put that chart, instead of it being the first, second, third of March, if you could figure out when the third week of March, because the main monthly OPEX is always the third Friday of the month. Always the third Friday of the month. The VIX, the last day to trade VIX, is always the Tuesday before that. Always the Tuesday before that. Always the Tuesday before that. Except July right here, where it's the next week. So it's like it shifts around a little bit. It's always the third Tuesday of the month for the VIX OPEX. And the VIX last day to trade, the fourth Wednesday, I guess the third Wednesday, is always the actual OPEX, but it expires as soon as the market opens. So really it's the Tuesday before. So when, if you're going to trade it, if you're going to get out, you're going to book profit, you're going to do anything with it, it's the Tuesday, third Tuesday. So this is what matters, the third week. Now, months like this, where we started on Sunday, or even months like, I don't see one that starts on a Tuesday. There's one. Months where we start on a Tuesday, we get that third week all in one. But months where we start on a Wednesday, we get this decoupling, and that's what happens right here. So that's why it shifts around a little bit historically. And the average comes out to be that we bottom on the 12th of March. Then typically after this OPEX, we rally into May. I have it off the edge of the, to zoom out just a hair. Pick up the other months. So if you were to go long here and trade it into that holiday, Memorial Day, historically you do pretty good. If you look at the chart here, you usually bottom here, rally into that May time frame. There's always the sell in May, go away. You see how flat it is right here? The May, we usually rally from that OPEX right up until Memorial Day. It's just a historical pattern. It has nothing to do with any geopolitical anything. Look at this. The sell-off, 20 years. The sell-off almost always happens. Last year, the excuse was Liberation Day. This year, the excuse is Iran war. What was the excuse 2 years back? What was the excuse 3 years back? There's always an excuse. Like, why is the market selling off? Historically, it doesn't matter. I've been warning about this on another chart too. Right here. Historically, we rally into the March VIX OPEX. Historically, we also rally into the October VIX OPEX. It doesn't show up as so much of a pullback, but chop right there. And then we rally into the end of the year. 10.4% a year on the last 20 years. People ask me, why don't you trade? Why don't you do negative trades? Why don't you, trade for the market dropping? This is why I don't trade for the market dropping. On average, the market goes up 10% a year. Why would you bet against that? Where's your statistical advantage? If you know the market goes up 10% a year on average for 20 years, actually this holds for like 150 years or something like that. On average, we're going up. Why would you bet against the edge? Now, I'm welcome. This is a real question. Like in the chat, why would you bet against the edge of? You have a 10% edge annually of the market going higher. Why would you bet against that? Most of you probably, hopefully you're here because you believe that I give you some clarity in the market, but I seriously wonder why people are always betting against the market. On average, we're going higher. Now, short term, we may go a little bit lower. This could last into next week. We did make this low back here on the 8th. We didn't make a big fat lowest low on the 12th here on the NASDAQ. We didn't make a big fat lowest low here on the 12th yesterday. So on average, we're not set up to make our lowest low on the 12th. We either made it here on the 9th or we're going to do something a little bit further down next week. Maybe today. So be careful. We're likely to make some sort of bottom. It's likely to probably happen next week, historically. Based on all the empirical data for years and years, this OPEX tends to be when we make a bottom. That's next week. What's coming in on the 18th? FOMC. That might be the excuse to cause a big sell-off. We might have the VIX OPEX on the 17th. We have the FOMC on the 18th. We get a big sell-off. Then we get the big OPEX for everything else on Friday. We kind of like take a deep breath, and then the rally takes hold from the end of the month into May. Typically, we cap it off with Memorial Day, and we kind of spend the summer chopping around. We get a little rally from July up through September, kind of when, as they say, traders are coming back to the desk from vacation, and then we get some chop in October. It's kind of the game plan. It's the game plan every year. It doesn't ever change. It's kind of like the human cycle of the market. Now, there can be, particularly strong times or particularly bad times, or, it's not a, typicality is not the exact path every year, but we kind of follow this pattern every year. By ignoring it, by trying to be counter trend and bet against the, I guess some people just like to be doom and gloom, but betting against the market on the long term, how's that work out for you? Now, getting a little bit of pop on NASDAQ, getting a little bit of pop on S&P coming in today. It was looking kind of negative, especially there at 4 in the morning. PCE came out this morning. Roll down here. So we had PCE coming out in line. We had preliminary GDP coming in way low. Like half of what they were expecting. Core durable goods, basically in line. Durable goods, preliminary JOLTS jobs are coming up here at 10 o'clock, which is like 10 minutes. Exciting times. Now, you don't have to go to Forex Factory. You can come right here, pick up all these data points and more, because they have year over year PCE actually pushed it down, trying to make it look good. Still, that's close to 3%. It's not, prices are still going up at 2.8% a year. Think about that. 2.8% a year. Something that cost $1,000 this year, going to cost you $1,028 next year. That's what 2.8% does for you. Price is still going higher. And then it compounds, from there. So I don't think anything's under control. And like I was talking about, this DGS2, we're seeing treasury. Look at this. Fed funds rate. Fed funds rate. Their target rate. 3.5 to 3.75. So the middle of that comes out to 3.64. That's the target. Right in the middle. That's the Fed funds. That's the orange line. The blue is the DGS2, 2-year constant maturity rate. If you've never seen this before, blow your mind. Everybody, even AI say that the Fed sets the market rate. Look at this. The Fed chased up the market rate. The Fed chased down the market rate. The Fed chased up the market rate. The Fed chased down the market rate. The Fed chased up the market rate. The Fed chased down the market rate. The Fed chased up the market rate. Ever since I've been trading, every time the market rate starts dropping before the Fed, except for right now. You remember what happened here? Memorable crash that we talk about. You remember what happened here? Memorable crash we talk about. Anybody know what happened here? Another memorable crash we talk about. Now we did have, funny enough, we didn't cut the rates to the bottom, but we did have, right here, there was a crash that was bigger than this crash. And we don't even call it a crash. And we didn't, the result wasn't cutting rates. The Liberation Day flush was bigger than COVID. That was a crash. It just doesn't show up here yet. This is instability in the market. They can say they saved the day, whatever. Eventually, we're probably going to flush it back down. But I speculated a couple of years ago that we may actually go through a period of choppiness and then have to spike rates. And that's exactly what's playing out right now. It's inflation ripping back. And then we cause a big financial crisis. So prices could go up even more. And if you've been hanging with me for a long time, number of years, I've got a chart that I showed off. Let me see if I can find it. This just came to mind that I should show this off. Talk about it. See if I can find it in here. I pin all this stuff so I can find it fast, and then I get so much stuff pinned I don't remember. Yeah, here it is. This chart. Anybody remember me talking about this? I mentioned we go through an all clear phase. This started May 2020. Guess how many months we are right now? Guess what's happening? We're in Act 3 of this. Inflation's coming back. We've done this before. We kicked this off in 2020. It's going to be like a 10-year thing. And prices are going to be actually, it's going to be like a little bit longer than a 10-year thing. It's going to be like a 12 or 14-year thing. But the prices we had in 2020, it's going to be kind of crazy. They're going to be cut not just in half, but divided by 2.5. So we're probably going to go through, if you thought inflation that we had already was ridiculous, we're probably going to go through a period where inflation is really ridiculous. So this is just history playing out again right here. And this is from Bloomberg. This is not like I made this up. This was back here in 2022. And then we went through this period, the Fed's declaring it all clear. We got it all. Everything's beaten. And now we're entering this comeback with a vengeance phase. Sucks, but that's the truth right there. Anyway, oil coming down, oil going up. It's all oil's trading. You look at it on the weekly. If we spike up and close above here, probably going on up. And I mentioned that we may retrace to that level, which we didn't quite get to. We got darn close this week. Now we're kind of closing in here. That could set us up to close up there next week or the week after, and then still go higher. This is all part of the same pattern. Came off the big low in 2020, move up, retrace, potential next move up. Could blow everybody's mind. We could go up into the 200s. Absolutely insane. So just kind of being real with everybody here. Russell holding on to the roadmap line. I don't expect any kind of super big chaos today necessarily. Next week's when I expect the fun, really. FOMC. Typically, when we're staring down the face of a FOMC meeting, we don't do anything too crazy. We wait till the FOMC and then do crazy. It's just kind of the way it works. Gold still set for this decline. Still working on it here. You'd be like, well, gold's up today, but it's still below yesterday. Gap down. That candle should be red, not green, right? How in the world did it gap down that much for the day? That's kind of the crazy thing when you look at the daily chart. Like, this trades 23 hours a day, 6 days a week. How did it get from up there down here? You start dropping down and you don't see that in here. You don't see that big gap. You look at the 1 hour. It's like, where's that big gap at? Where's that gap on the daily chart? But this gold is likely to continue down this path. Bitcoin coming on up. Target right up here. And watch out. Probably enter a correction. And then get another move up. It's the path I've had outlined for more than a month now. Probably come up here into May, June, and then sell off. Down, lower, low again. Ether might push up into 2,500 area. Dollar index. There we go. Pushing higher. Highest high for the year so far. This gets above 102. Things are going to get really spicy really quick. Get up into 102. Wiki going up to 120, 130, 140, maybe even a new high. And this has parallels all the way back here. See how we were pushing it down? Doesn't this look really similar right here? Yes, we were pushing the short dollar. Boom, and boom shakalaka. Raging inflation. That's what came out of it right there. DGS2. Look at that crazy 16%. You think these people that bought with rates at like 6% on their mortgage, planning for mortgages to go back down to 3% so they could refinance, what's going to happen to their plan? We go to like 16%. All the moaning and griping and complaining. I was only speculating maybe up to 10%. We've got this president. I mean, it's just repeating what we've done before. Could go even higher than 140. This is just wild right here, how it's playing out. It's like, why? What was the why? And Goose asked me for a couple of years now, what's going to be the why? It's all kind of coming together. It's coalescing together. And it could report, the results coming out of this could be a greater depression type of thing for a lot of Americans. NKD, this is global liquidity. Looks like the trend, the new small time frame trend, 1, 2, 3. We may see it spike up here and then flush out, and that could happen next week. Could get out of control. Every time we see the NKD take a big swift move down, we usually get a big flush out in the market. That's why I keep an eye on it. Global liquidity. This is indicating that we are setting up for a flush out that can spill over in the U.S. markets, exasperate a move down. Apple sitting on the roadmap line, just kind of churning. Potential to drop on down, or if we can hold, rally on up to 295. Coin flip a little bit here. This is secondary bounce, almost a tertiary bounce. This almost bounced twice here, but this is the first bounce. Not quite touched there, so this is the second bounce. If we can get through the downtrend of highs, going on up. If we push on lower than this low, probably coming down here to the 208 area. Amazon, looking for this to hold the uptrend of lows, break through the roadmap line, get these gaps filled, and go back to the prior high. That's my expectation. Google, looking for this to dip on down, complete this correction here. Meta, back down to the uptrend of lows. Can we hold it? If we poke below it, we're probably going to make a lower low. Probably going to reset this. I wasn't keen on how this set up, but so far it's holding. If we keep holding here, this can have explosive upside. 1,100 to 1,300 would be the target area, but we may have to reset it before we embark on that journey. Time is the hardest part. The target's already set, but it's just a matter of, do we launch now or do we take more time to churn through it? Now, Bud is a good example of this. It just took way longer for this to get off the mat. We had this big move up, this big retrace to a 618. You can be like, oh, it was geopolitical, blah, 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 blah. And it took it. And we haven't even, still haven't even got up to the 107 yet. Still likely to come on up there. It's just taking it much longer to get through this right here. Yeah, we hit the 618 right there. Hit it again. Move up, retrace. We're looking for this to get the continuation on up. So Meta maybe have to, because of where we are and how everything's playing out, we may have to come back down here and hit again before we can take off. Microsoft still hasn't proved we were going to hold support here. I wanted to see it ideally hold here. We got below that. Now we bounced off the bottom of that. This can go lower low than the low we had back Liberation Day. We can end up all the way back down here. In fact, I'm going to put a target zone down here. Put a line in the sand here. If we get below that, I think we're going to target that area down there. time, I'm not sure. And the way we've been dropping could take it well out in the late summer. Yeah, this has been pretty fast right in here, but it may take another earnings or so before we can get on out there. Nvidia, it's been holding on to the roadmap line really freaking well as it climbs up. But the enthusiasm seems to be waning a little bit, and we may drop down to this 150 test. And that's the highs from back in December 2024. 2 years back, right there, where we peaked out. We haven't really been back to test that breakout right there. We cruised right on through, and this would be a retest of that breakout. Common thing that happens in the market. Tesla. Potential to dip on down here. 370. Still in the cards. Tried to get through the roadmap line. Tried to get through the downtrend of low or downtrend of highs. Tried, but wasn't successful. May need a trip down to 370. Clean that up. Netflix bounced off the roadmap line right there. Pulling back. We may see this get continuation right down here before we can bounce on through. That next 618 up here for the big drop we did into this low. That resistance is right up here, and that'll be the real tell. Like when we test that resistance at around 108, like, does that hold and we turn down? That would mean we're going down lower low than this low right here. And right now, this could be an A wave. This sudden move up, I would expect a retrace of some sort, then a test up here. That'll probably be the B wave. And then if we go lower low, that's the C wave. But this also could be complete over here. Just came up a little shy where I expected it. I mean, we went deeper than my primary expectation, but we went shallower than if this was complete with the move deeper. So it's kind of in a quandary. It's like, it made it unclear. It's like, is this finished, or are we going to come up here and go further down? Not sure. Now we did hit the minimum right there. That right there, that 50%, we could just go on down from here, make a lower low. So if we get below this 82, 83, 84 area, starts tipping the odds, we're going to go lower low immediately. If we push on up above 108, tips the odds that this lowest low right here was the low. And we can go on higher. That's a lot of red drawing. So, clear as mud. And that's not the right list for today, I don't think. Reload the list. Yeah. I didn't think so. KRU popping, but EWY still set for returning to the roadmap line. Now, they could do something like that, similar to what I was just talking about on Netflix. Or that could be all the bounce we get, and we go ahead and flush it right now. There's no telling exactly which way it's going to be. But this is looking like we're going to go ahead and push on down. Similar to what I said on gold, similar to what I said on Netflix. So that's KORU for you, which is the 3x leverage on the EWY. SanDisk, sitting here at the highs. This has gone nowhere. Kind of hit a wall here. Watch out for that retrace. Might have to happen before we go higher. Of course, it could just break out again. Lumentum. This thing was on a monster run and probably needs to have a pullback. I mean, the last pullback was all the way back here. And then it just went blasting higher. They eventually run out of juice. Same kind of chart here. Probably going to come back to the roadmap line. Coin. It's probably coming up to the roadmap line. And then we may see another decline. So this may rally with Bitcoin, decline with Bitcoin, rally with Bitcoin, decline big with Bitcoin. Kind of proxy it for Bitcoin. MSTR still has that date with the roadmap line up there. STRC. Ooh, little sell off on the dividend there, looks like. Opportunity to add some if you wanted to grab some. Add some and grab some. Any decoupling off 100 is an opportunity. APD. That didn't actually show up in any of my scan there, but high, low, entry 299. Probably come back to the roadmap line. CIN, probably come back to the roadmap line. AMAT, probably come back to the roadmap line. Same. That's on the bottom. Now, I've not seen so many insiders selling as I have in this company right here. Insiders are bailing on their shares left and right. They have no faith in this going higher from here. So watch out for that to take a spill. Bigger proportions. Circle, trying to push through the roadmap line. We can actually maintain a move above, find support. This thing can call this the bottom. Potential for it to be the bottom. And it may hang on the Genius Act and the Clarity Act. Like, are those, is the Genius Act going to remain as is, or are they going to repeal it and replace it? And then can they pass the Clarity Act? That's all hanging in the balance for Circle and their stable coins. Lots of stuff moving. It's going to be... Ooh, Ulta, back to the roadmap line. That's why I say these things can come back very quickly. That thing popped up, hit the target, retraced. Hit the, beautiful. It's a big time frame that worked out. Smaller time frame, this worked out to a very lofty target. Coming back, retesting the breakouts is what we're doing right now. Let's break out across there. Let's see, just remove a few lines. All the lines. This breakout coming across here, that's what we're retesting. Similar to what I was talking about on needing to do on NVIDIA. If we can hold it, that can be bullish. If we get below it, it could be in for more correction. Ooh, getting close. Dip on down to 215 on Adobe. USO pulling back just a shade. Not really even a blip, hardly. About to break out higher again. BBLT. Looking for this to hit the roadmap line. In fact, I'm going to put an alert right there. That's Palladium. Oh, so close. I want to see it hold. It's getting close. All right. SPY. Let's read the tea leaves. Let's see what we got. Set her up for today. Now we've had this giant level sitting down here at 660. Still got this giant level. Probably check it here in a second. I pull up bullflow.io. Links in the description. And I need to reset this back to today. Reload, refresh, pulling over. So we've got this big level 660 sit down here for next Friday. we've got these levels stacked in here too. 200 million, 400 million, 100 million, 200 million. Look at that. 700 million down there at 645. The market's pricing in some chaos. 400 million here today. 300 million up here. 700 million down here at 660 today. Pricing in some chaos. Definitely. Even down here, 257 million. So the problem here is it's not all clumped together. It's spaced out. That can cause acceleration lower. You see these big levels over here on the 20th. Big level, big level, big level. It just keeps going down. Looks like that one right there. 640. That'd be a pretty big flush out, right? So we've got that big level today sitting there. 660, 700 million. Would not surprise me one bit to pull this right down to it today. It's going to be hard to come up with a bubble exactly because the upper big level is up here at 675. But the lower big level is actually down at 655. For today. That's a big range, like a really big range. This 660 sitting out there is the biggest level on the board. $1.1 billion of gamma. And that's not $1.1 billion of options. That's $1.1 billion of hedging that has to take place for every dollar of move once we get down in that area. A little bit crazy. Now, I like to look at the levels and just kind of try to pick out where the balance point is. Now, the problem is there's skew at this point. We have several big, and this is what the big options expirations do for you. You've got this big level stacked in here, and until we clear it, the board is pretty stacked in here. So this creates a muting action on options. And if I was going to pick the point where the purple and the yellow are mostly balanced out, because that would screw the most number of options holders, it looks like somewhere right around 660, 668. Probably. It's where the call holders all lose their money and the put holders all lose their money because price isn't dropping and price isn't popping. And there's kind of that flip point. Now, the puts are kind of stacked a little higher, and that's what makes it difficult is, like, are they stacked on this expiration or are they stacked on this expiration? That's what makes it difficult. Somewhere around 668, which is almost where I've got that line sitting. That looks like where we might hang out today. Right in that zone. And that's right where we're sitting right now. Funny enough, that's why price is kind of sitting there, is because that balance point in the puts and calls. And if price just hangs out there, the market makers that sold all those puts and calls keep all that money, and all those put and call holders get screwed. And that's how this game works. As we have more and more zero-day option players, this effect is stronger and stronger. But we still have this big monthly OPEX skewing the data in here. So once we get through that, that's a monthly OPEX, quarterly OPEX. It's like a quadruple witching, they call it, where it's like 4 time frames come together at the same time. Now, I like to play in the NASDAQ side, Qs. Now, why am I not just looking up IndX or SPX? It's because those index options are weird and they don't, bull flow doesn't really support them that much. So there's kind of a flip point right here, right at 600 on the Qs. Flip over the Qs. And we still got this flip point right at 600. And we may hang out there. We were hanging out there yesterday. We may hang out there today. Bring it on over. Now look at the gamma levels. The gamma heat map for the Qs. A little bit better bubble. You know, this actually has, see this bright green clump together here. Pull it off of my face there. This bright green clump. So we've got that clump goes all the way up to 611 today so far. But then we have these big levels all the way down here to the 400 million. Now 400 million, much smaller. Even though this is big tech, lots of big money plays in big tech. We've only got 390, almost $400 million in gamma here. So this is a lot more balanced. A lot less people playing in big tech right now. And it goes, so kind of supports that rotation narrative. So 590 is still the big level on the board. So we're going to have to put the bubble up to 610 and down to 590. Expansion of range today. But based on the levels, that right there, we may take a trip down to here and back up. It's possible. That's how we've got it stacked in there today. If you're trying to play immediately on the bear side, just like yesterday, I'd be down here in the low 2,400, 24,000s. I did play I played some contracts early yesterday, and somebody was like, "Why'd you do that?" It's back into the gamma bubble thing. Like the bubble's saying we're gonna stay between 590 and 610. So if you play down in here, and this is just a multiplier, it's not exact, but this just supports that if you play down in here or up above that 610 level up here, so you could play some sort of options in there. You know, it didn't matter what it does in the bubble, you're basically more than likely going to be safe. Now, I don't usually play my full boat early down here because chaos can ensue. I could be taking on more risk for a loss because the gamma bubble's not guaranteed. Like, it can just let the rope go. Like we saw in the SPY. We have those levels all the way down to 645. Like, that's all the way down in here. Like, if this thing let go, we could come all the way down in here. It's way below the bubble. That's going to be the same way it reacts on Qs. Like, if we get below the bubble, we could be cruising on down lower. And there's big levels all the way down to 565, which I don't even have marked on here, but we're talking about levels down here. Kind of see it, you know, that'd be the 580, 575, 570, 565, 560. I mean, we could be way on down there if this thing got away. So be careful out there. I'll be on Market Masters at 11:30, about an hour from now. I'll be back here, same bad time, same bad channel, Monday morning. Do it all over again. Have a great day.